So let's shift our focus from real estate to equities, and I'll stay with the theme of glasses half empty and glasses half full. If you're in the half empty camp on real estate, you're going to point to, on equities, you're going to point to the US fiscal imbalance, you're going to point to the continuing crisis in the Eurozone, you're going to say China's coming for a hard landing, the Canadian housing bubble is a bubble, there's a record amount of consumer debt, and demographics for developed countries don't look good. Now, if you're in the glasses half full camp, you're going to say, and Rob pointed this out with his statistics, there's a huge housing recovery going on in the US right now. There's record corporate cash on companies' balance sheets. Yes, while demographics may not bode well for developed countries, people are working longer, not necessarily because they have to, but because they want to. Emerging markets have significant growth potential. Technology advances provide for increased productivity. And lastly, on the debt story, of course, I mentioned that it's only a partial story, and that in fact, especially for Canadians, it's not that bad a story at all. Now, all of these points make for interesting discussion, and while I don't want to diminish their importance, I will point to what some of the most successful investors around the world, and maybe what some would argue to be the most successful investor in the world, Warren Buffett, looks at. He says, all of this is short-term noise. And here is what really matters. These questions. Will the global economy be larger in 10 years' time? And will GDP per person be higher? And his answer to that right now is yes. He's had comments recently mentioning that he feels that the US equity market is in a bull market and the place to be. And we would tend to lean towards what his thinking is. So, the madness of crowds. Many of you have heard that expression before. And what that means is by the time something hits the headlines, using this as an example, in fact, the opposite ends up occurring. This is Business Week from 1979, The Death of Equities. And the reason they came out with that title, of course, is because for the previous 10 years, from 1968 all the way to 1978, over a 10-year period, equities produced a 0% rate of return. So are we back to the future? This is a financial newspaper from May of 2012. What's the headline? The Death of Equities. Rob mentioned Bill Gross. Bill Gross, head of one of the world's largest bond fund managers, came out with the same comment, the death of equities. Well, yep, and again, same thing. The reason being that over the last 12 years, a 0% rate of return in US equities. Shortly after the Business Week headline, basically from 1970 all the way through to March of 2000, a 20-plus year bull run in the US stock market. Over 1,500% was the total rate of return. So, could we perhaps be looking at the same? Here's some stats. The S&P 500 has produced a 1.9% rate of return over the past 12 years. The Canadian stock market, a 5.2% rate of return. When you adjust this for the change in currency, if you're a Canadian investing in the US market, that's a minus 1.3% rate of return that you've earned over 12 years. Canadian, it's still 5.2%. So the difference between the two is 6.5% per year. Lastly, on the equity side, I'd like to finish with what we think could be a game changer. This is New York Times just recently, citing that the US within the next 5 years will be the world's top oil producer. Top right, what you're looking at here is the combined oil and gas production in the United States going from 1980 and looking forward. And what you're seeing, that bottom dip in the middle is 2005. And since then, there's been a huge surge in oil and gas production in the United States, mainly coming from what's called unconventional oil and unconventional gas. And by unconventional, they simply mean they're accessing this oil and gas in areas that otherwise, prior to technology being developed, in areas that were otherwise uneconomical. So a huge jump in oil and gas production. What you're looking at on the bottom right is net oil imports in the United States, looking forward over the next 15 to 16 years. And if this one item occurs, this will have the effect of cutting the U.S. trade deficit alone by almost 40%. So that's a great story for the United States. This clipping right here that you're looking at is Nucor. Nucor is one of the world's largest steel manufacturers, and they changed their minds from locating a $750 million plant that they wanted to build in Chile, and they decided to build that plant in Mississippi. Why? Because of the cost of energy. The huge drop in gas prices gives U.S. manufacturers a significant advantage. What you're looking at here on the top right, a 13.6% decrease over the past year in coal energy consumption compared to a 23% increase in gas energy consumption. This is from The Economist, with the key takeaway being, right now, it costs a manufacturer just as much to produce in China as it costs to produce in the United States. There's very little economic advantage for a U.S. company to be in China. When you factor in wages, logistics, productivity, transportation, energy costs, and duties, it's about the same. And I think Rob pointed to the amount of jobs that we're seeing occurring, job growth that we'll see occurring in the United States. So this is all a good news story. Somewhat related on carbon emissions because of the drop in the amount of coal and the increase in the amount of natural gas. While the United States did not sign the Kyoto Accord, the United States will hit all the targets of the Kyoto Accord. Canada, on the other hand, signed the Kyoto Accord, not going to hit the targets.